Have you wondered if Amazon is set up for a new great bull run? If now is the time to get in and buy this stock? Or have you wondered if there is more pain ahead in the coming years? And what does Warren Buffett think of Amazon? In this video, we'll try and answer these and many more questions. Amazon's stock price has been almost cut in half in the last year, and we are starting to wonder if this is a great buying opportunity. But before we get into this, we need to understand Amazon a bit better, because the company is so much more than just an e-commerce giant. It might come as a surprise to a lot of people, but the actual e-commerce business of Amazon, storing goods that Amazon itself sells via its websites, accounts to only 47% of its revenue. So that's less than half. This alone shows that Amazon has done a great job in diversifying its income over the years. What started as just an online bookstore has now become so much more. The second largest source that accounts for 22% of its revenue is third-party selling services. These are the commissions, fulfillment and shipping fees Amazon gets from selling third-party goods. As you might be aware, it's not just Amazon that sells on Amazon. There are actually thousands of vendors using the Amazon platform to sell their goods. Now, the third source of revenue is AWS services, their on-demand cloud computing service. If AWS was a company by its own, it would still be a huge company ranking high on the S&P 500 with a revenue of $62 billion in 2021. But here it accounts to only 13% of its revenue. AWS has for years now been a star in the Amazon sky, performing with high gross margins and high revenue growth. And it is not only performing amazingly well compared to itself, but when you look at market share, you would never believe that they are the largest by far. Having a 34% market share in this high competitive market is something I wouldn't bet Amazon on doing, but they are. As a fourth source of revenue, we have everything associated with the Prime subscription services. Again, this only counts for a meager 6.8% of its revenue, but only 6.8% is relative because it still stands for $32 billion in revenue in 2021. And remember, this is a steady source of income and one where they can easily tinker with the profit margins by just hiking up the price now and then. As a fifth, Amazon is also smart enough to sell advertising space on its platform. Having these huge numbers of users and traffic gives some great potential in advertising, one which they don't shy away from, making another 6.6% of their revenue. The last couple of years, Amazon has been setting up more and more physical stores, and with the purchase of Whole Foods 5 years ago for $13.7 billion, they now have 520 Whole Foods markets, 44 Amazon Fresh grocery stores, and 26 Amazon Go convenience stores. But they only bring in a 3.6% of their total revenue. The last source of revenue is classified as others. A lot of companies would have a hard time classifying a 2.1 billion revenue stream as others. But this just shows us what kind of beast Amazon is. With a revenue of almost $470 billion in 2021, it's difficult to wrap your head around just how big of an operation this company is. Now that we have a good understanding of what Amazon does, why is Amazon stock this much down? And is it a buy or something to stay away from? Well, there are a couple of factors that led to the stock price decline. E-commerce companies reckoned with a tough year-over-year comparison, and the economy started to reopen, leading many people to return to physical stores. By early 2022, higher costs tied to inflation, supply chain constraints, and the war in Ukraine generated further pressure on Amazon and other tech companies. But for Amazon, there was more going on. Amazon was facing with slowing growth in its core retail business, and the company has been forced to scale back after its historic expansion during the pandemic. The new CEO, Andy Jassy, has been reviewing all the company's expenses, resulting in some programs being shuttered and a hiring freeze across the whole workforce. They have also begun to start laying off people and will extend this into next year, as stated by their CEO. Now, the final thing they did this year is projecting lower than expected sales for the Q4 quarter, between 140 and 148 billion, while analysts had an average forecast of 155 billion. It isn't helped by the fact that in the last couple of months, the operating income saw huge declines year over year, making people wonder if the golden ages are over. If you look at their free cash flow as of September 30th, it's negative $4.9 billion. If you compare this to Microsoft that produced $63 billion or even Netflix that has a positive return, you can clearly see why this has investors spooked. AWS has been a bright spot for Amazon, but of course, if your total numbers in income are the way they are, the question is, will the number 2 in market share, Microsoft, be able to dethrone you? They have a much bigger war chest and have stated many times that they see the cloud infrastructure as a huge growth market where they are more than willing to invest in. Given the fear of a further recession and further declines in 2023, the company might be lagging behind for the next couple of years. Since Amazon is down this much and with the negatives surrounding the company lately, it's sometimes hard to see the bright spots that are nonetheless easily found when you look for it. AWS is still the market leader and continues to show great growth. What is furthermore AWS is a highly profitable part of the company. AWS made up more than 70% of Amazon's total operation income. That's just incredible. AWS operation margins are about 30%. If you compare that to their retail operations of 4%, we can see why there is still huge potential in this business. Like I said before, Prime is a great reliable source of revenue and income for Amazon. They already have more than 200 million subscribers worldwide, and now with the release of shows like The Lord of the Rings, The Ring of Power, this must have made them a lot of new subscribers. And Prime subscribers are sticky revenue growers. The Prime subscription gives people a big incentive to stay on the Amazon platform and spend more time there. The layoffs the new CEO is putting in place is setting up the company for future profits. After all those layoffs have been priced out and revenue in retail will continue to grow as it has done year over year, we should see the profits we were used to come back and push the stock to new highs again. Don't forget about their advertising business either. You might think that this small portion of its revenue, 6.6% to be exact, is meaningless. But this makes Amazon the third largest digital advertising company in the United States, only ranked behind Google and Facebook. And with a revenue of 30 billion last year and on track to do 40 billion this year, so another huge growth story here. And with all those things in mind, we must not forget that the economy will bounce back, even if we have another year of economic problems. The economy will always bounce back in the end. Then you will want to be ready for a new bull run. Amazon is currently trading at around 1.7 times sales. That's the lowest it has been since 2015, and it's not as if the company is about to go bankrupt with a cash balance of around $58 billion. We didn't even bring into account the many innovative things Amazon is always working on. And if you still have doubts in Amazon, maybe you should listen to Warren Buffett, what he has to say.
And on Amazon, and why hasn't Berkshire bought in?
Well, because I was too dumb to realize what was going to happen. Even though I admired Jeff, I've admired him for a long, long time and watched what he was doing, but I did not think that he could succeed on the scale he has, and I certainly didn't even think about the possibility of doing anything with Amazon Web Services or the cloud. So if you'd asked me the chances that while he was building up the retail operation, that he would also be doing something that was disrupting the tech industry, that would have been a very, very long shot for me. And I've really underestimated the brilliance of the execution. I mean, it's one thing to dream about doing this stuff online, but it takes a lot of ability. And you can read his 1997 annual report, and he laid out a roadmap, and he's done it in spades. And if you haven't seen his interview on Charlie Rose 3 or 4 months ago, charlierose.com, go to and listen to it, because you'll learn a lot. At least I did. So I just plain, it always looked expensive, and I really never thought that he would be where he is today. I thought he was really brilliant, but I did not think he would be where he is today when I looked at it 3, 5, 8, 12 years ago, whenever it may have been.
Now, would I recommend you buying Amazon? Well, yes, I actually would. I would try to dollar cost average into this stock and let it sit there for a couple of years. I'm pretty sure by what they are doing right now, this stock will be a winner in the long term. But if you want to learn more about another e-commerce giant that has even better profit margins and is way cheaper, you should have a look at this video.